The stock market crash of 1929, also known as the Great Crash in the history of stock market. Dow Jones fell by 83.4%, eroding the wealth of so many investors. The 1929 market crash wiped out billions of dollars in wealth, leaving investors financially devastated and triggering the Great Depression. Our own favorite index Nifty fell over 64% in the 2008 market crash. So, if you are an investor in Indian markets during that time, you would have lost more than 64% of your investment, again based on the stocks you have invested. Some technical analysts claim that if you had followed the technical analysis, the price would have indicated that we should have exit all our investment at the break of trend line, thus saving a lot of money. But for a common person, which one is beneficial? Study of fundamental analysis or study of the technical analysis? Today in this video, I'm breaking down fundamental analysis versus technical analysis in a simple manner. Let's see which approach can help you to make smarter investment decisions. Friends, understanding the differences between fundamental analysis and technical analysis can be tricky. But if you use daily examples, it will help you to grasp this concept in a quick manner. Let's assume you are planning to buy a new car. But like me, you are not interested to know the technical specification of cars. All you need is the experience matters. Now you have two choices. Number one, you see the cars on road for some time. Let's assume many people are driving Mahindra Thar car. So you assume this might be a good car and you buy it, just assuming it will fall within your budget, okay? So this is similar to technical analysis where you only see the price and volume when you are making the decision, okay? The second option is to visit each car dealer and test drive their popular car. Whatever car you like, you buy it, once again assuming it will fall within your budget. So this is similar to fundamental analysis where you study and compare different cars. In simple words, fundamental analysis is like a company's financial health report card. You look deep into company's numbers like sales, profits and debts to understand its true worth. You compare this value to the stock price to decide if it's a good investment or not. Whereas technical analysis is like studying past price charts and trading volume to predict the future price movement. It focuses on patterns, trends, and statistical data rather than company financial. So traders use tools and indicators to identify potential buying or selling based on these patterns actually. But you should remember technical analysis makes some assumptions. Number one, market discount everything. Number two, price moves in trends. Number three, history tends to repeat again and again. Number four, how is more important than why? Friends, many people are not interested to learn or explore fundamental analysis because fundamental analysis contains too many parameters like ROE, ROCE, P ratio, debt to equity ratio, cash flow, net profits, and there are so many things. People get confused whether to study, all these parameters, which parameters to pick, which parameters to ignore. They don't get the clarity of all these things and hence they are afraid of fundamental analysis. Friends, in my opinion, all these parameters, at least some of these parameters are interconnected with each other and studying all these parameters are not really important. If we pick only 3-4 important parameters which are more than enough actually. So what I do with this approach is I will give a simple approach in which we will study only 3 parameters and then we will do the fundamental analysis for any stock, with examples. So time being, we will get rid of all these parameters. So I will take a simple business example. It is a very simple business example to explain the importance of explain three important parameters in fundamental analysis. Let's say you have a friend, okay, who wanted to start a new business. You have a friend who wanted to start a new business. Let's say his business idea is to buy a new car, and he himself drive the car for a Uber or Ola or any some other company like that. So you have a friend who is interested to start a new business. His business idea is to buy a new car and drive himself for Uber or Ola. Now let's assume the capital required for the car is 10 lakh rupees. This is just for an example sake, okay? So you have a friend who is interested in new business to buy a car, drive himself for Uber by investing 10 lakh rupees. So this is the business idea. Let's say he starts to earn 50,000 rupees profit every month. This is just for an example, okay? So this 50,000 profit excludes all the expenses. Let's say the diesel expenses, insurance, everything, all the expenses. After excluding all these things, he starts to earn 50,000 rupees profit every month. It means he earns 6 lakh rupees profit every year, right? For the first year. So what is the profit in terms of percentage and capital deployed? You will say, Indra, this is very simple, right? So this is, it's only 60%. It's not only 60%, it is 60% because 60% returns on any business is too good. Now, this is nothing but ROCE, friends. ROCE stands for return on capital employed, ROCE. Now you got one important, you have understood one important parameter in fundamental analysis, which is nothing but ROCE, return on capital employed. The employed capital in this business case is 10 lakh rupees. So he earned 6 lakh profit for the first year. So in this case, ROCE, return on capital employed, is 60%. I hope this is very clear, right? Now let's move on a little bit. So if you visit Screener website, you can get this ROCE information for any company in Screener website. You check for Infosys, TCS, for any company, you will get this information. So now any ROCE which beats the inflation is good. So in any developing country, at least in India, the inflation varies between 6 to 8 or 6 to 9%. So any ROCE which beats this inflation is good because we need to beat the inflation, right? That is the idea of the investment. But if you add some extra filter, some extra cushion and all, so anything which is above 15% ROCE is good. If a company is delivering 15% ROCE every year, which means it is a good company actually. Now we will come back to the same example. Friend, Uber car, 10 lakh rupees is the investment. Let's assume your friend only has 5 lakh rupees in his account. He don't have the 10 lakh rupees required to buy the car. He has only 5 lakh rupees in his account. So he will say, the group of friends, you are a friend with him. He will say, give me, you 5 people, give me 1 lakh rupees each so that I will buy the car and I will run the business. I will also share the profit with your case, as per your capital. Okay. So in this case, he agrees to share the profit with all the members. Now assume you also paid 1 lakh rupees for him at the beginning. So he earns the same amount, 6 lakh rupees profit after 1 year. So you received 60,000 profit after 1 year, right? Because you've invested 1 lakh rupees and you got 60,000 profit after 1 year. So this is nothing but ROE, return on equity. It's very simple. So previous one is ROCE, return on capital employed. In this case, return on equity, ROE. So again, if you check Screener website, it will give all the information I mean the ROE information for all the companies. In this case, Infosys has 31.8% ROE for the last financial year. Now you might ask, Indra, ROE is same as ROCE because in the earlier case ROCE was also 60%. In your friend's business case, ROE is also 60%. But both are not same. It depends on debt and additional capital, etc. So ROE and ROC is in most companies cases it's always different. So as a thumb rule, anything about 12% ROE is good. So you just follow either ROE or ROCE. So if you want to follow ROCE, look for 15%, anything above 15%. If you want to follow ROE, so look for anything above 12% because ROE, most of the cases it is less than ROCE because they will take some money for the debt and extra additional capital, etc. So my suggestion is look for any company which has with ROE greater than 12%. Okay, I hope this is very clear. ROE is above 12% or ROC is 15%. You make it simple. Take ROE greater than 12%. I mean 15%. Now we will come back to the same example. So in this case, his original investment is 5 lakh rupees, right? So loan taken from friends is 5 lakh rupees. So which means if you consider the overall equity is 10 lakh rupees, then the debt to equity ratio is 0.5. So equity is 10 lakh rupees in this case. That is the cost of the car 10 lakh and the debt is 5 lakh. He took the loan from 5 friends, right? It is 5 lakh. So in this case, debt to equity. Debt is 5, equity is 10. 5 divided by 10. So his debt to equity ratio is 0.5. So you have understood one more important parameter, ROE and debt to equity ratio. In general, debt to equity ratio should be less than 0.25%. Again, there is a big debate about this. Many people argue about this. You consider it as a simple example. Let's say one person, he can survive and earn money with 5 lakh rupees loan. But one person may not survive and earn some profit with 5 lakh rupees loan because he thinks it's too much. Similarly, another person can earn and sustain with 50 lakh rupees loan, but another person may not earn and survive with 50 lakh rupees loan, right? Again, it depends upon the individual. Somebody have the pressure and they can take the stress of a loan and they can run the business and they can make the profit. Similarly, it's applicable with companies also. Certain companies have the ability to accept and process more debt and they can generate profits actually. So but as an investor we should follow the proper thumb rule, or general thumb rule. So the general thumb rule is debt to equity ratio should be less than 0.25%. This is a better thing. So in your friend's case, it is 0.5%, right? So 0.5% is not good actually, it is more. So ideally it should be less than 0.25%. So in your friend's case, in Uber car case, it is 0.5%, which is not good. So similarly, if you go to Screener website, you can get that information, debt to equity ratio. So if you look at debt to equity ratio for Infosys company, it is only 0.1%. So this is very, very good. Similarly, if you look at debt to equity ratio for TCS, it is only 0.09, which is too good actually. So this indicates this company has very, very less debt compared to the equity. Similarly, if you look at Sun Pharma, it has only 0.05% debt. So this is still too good, which means it has very less debt compared to its original equity. So coming back to your friend's case, let's say he is running the business, he will show some numbers. So how do you verify your friend's business? How do you ensure whatever the numbers he has shown is genuine or authentic? So the simple way is by looking at his bank passbook, assuming he will collect all the money through phone pay or google pay, or you can also look at the uber business sheet, then you will see the overall entire picture for the year, right? Similarly, to study any business, you can look at the net profits. So there will be a tab, dedicated tab under fundamental analysis for any company, which is called as net profit. If you see the net profit, at least it should be the same for every month or every year, or it should be in increasing format. So if it is in an increasing format, it is really good. It indicates business is growing with the time. That is also very important. So now if you look at this is a net profit tab for TCS. So this is a tab which gives for every year, March 2013, 14. So from 2013 to 2024, if you observe very carefully, it is increasing. Okay, net profit is increasing every year, right? So 2013 March it is 14,000 something. So next 19,000, next 20,000, 24,000, 26,000. So only exception is 2018 it is 25. Next 31, 32, 32, 38. So it is almost increasing every year, right? So net profit increasing every year is an ideal scenario. You can look at one more example. This is net profit in Reliance. You can see, so every year it's almost increasing, right? It's almost increasing every year. So this is a good sign of a business. Net profit should be increasing. So now using these three parameters, you can study and analyze any company. So ROE, return on equity, should be greater than 12 to 15%. No, 12 or 15%, both are good. 15% is also good. Debt to equity ratio should be less than 25%, which means debt should be less, and net profit should be increasing every year. Now we will see the same information for some of the companies in Screener website, then we will get some clarity. So what I do is I will go to Screener. So I will search for the companies. For example, if you look at for Reliance, we will study only these three parameters. It gives the picture. See, ROE is 9.23. Look at ROC or ROE. We can look at ROE. That is more than enough. So ROE is 9.23%, which is little above the inflation. So this is one thing. It is not an attractive returns. And look at debt to equity, it is 0.44. It is greater than 0.25%, right? It is little greater than 0.25. So this is also a little bit risky. And if you look at the profit loss, net profit, this is increasing every year. So this parameter is positive. This is really good. But the other two parameters are not so attractive. The ROE and debt to equity ratio. If you look for some other company, let's say we'll look for Titan. Again, if I look for a Titan company, ROE is 32.9%. This is too good. Return on equity is very good. 32%, 33%. It's almost. Whereas debt to equity is 1.65. So debt to equity, which means this company is carrying more debt. Reason I don't know. It is carrying more debt. It is bit risky actually. As I said earlier, some individuals have the capability to carry more debt and run the business. Similarly, some companies have the capability and ability to have more debt and run the business. So as an investor, it's up to you. If you're ready to take the risk, it's up to you. If you go to the profit loss statement, net profit, it is kind of increasing. Okay, except these 2 years, it is kind of increasing. So net profit is good. So out of three parameters, it scores well with two parameters. Okay, so this is with Titan. Let's look at some other company. For example, I will look at Sun Pharma. If I look at Sun Pharma, ROE is 16.7%, which is decent, very good, 16.7%. Debt to equities, it's almost nothing, 0.05%. This is also good. So this is also good, friends, and this is also good. Now, if you go to profit loss and net profit, it is increasing almost every year except here. 2018 to 2022, it didn't increase, but it started increasing from here 2023-24. So this is quite decent. Okay, now if you look at some other company, for example, I will look at Tata Motors. If you see here, ROE is 49.4%. This is too good. It's very, very good. But debt to equity is greater than 0.25%. It is 1.26%. So which means it indicates it is carrying more debt. If you go to profit loss, net profit, again, it is increased here, but it decreased here. It is negative here. Once again, it increased here. It turned positive. It is more here. So this is, from 2019 to 2022, it is the profit is actually negative. Okay, so the reason is I'm not sure, but you always look for some companies which scores well with all these three parameters. That's how we analyze we study any business, right? So let's look at some other company. For example, what I do is I will go to Money Rediff. I'll pick some small companies so that we can understand it in a better manner. I will pick any BSE, for example. I will check, for example, Shriram Finance. So if you come here, if you type Shriram Finance, we got the company. ROE is 15.9%, debt to equity is 3.99%. You can make it, right. Net profit is increasing every year. Yeah, it is increasing every year. So this is one example. For example, if you look at some other companies, for example, what I do is I will search for Solar Exchange. Let's see Solar Exchange, how Solar Exchange is doing. Solar Exchange itself is not there. Solar Industries. Okay, Solar Industries, it is there. So Solar Industries is ROE is 30.9%, which is good. Debt to equity is 0.34%, which is a little above 0.25%. It is decent. Okay. Now, if you go to the profit loss statement, net profit is increasing every year. Yes, it is increasing every year, right? So this is how, again, you should do your own analysis. These are the just three parameters to search for companies for the long-term investment. Friends, to know more such fundamental concepts as well as technical concepts, you can read my book, How to Make Money in Stock Market Trading, which is published with one of the India's leading publisher, Jaico Publication. Because I have explained many more further fundamental concepts as well as technical concepts in detail in that book. Now come back to technical analysis. So now, once again, similar to fundamental analysis, there are many concepts are there even in technical analysis. But from an investment perspective, I'm going to explain one of the important yet powerful trading concept in technical analysis. So it is called as Dow theory. So basically, Dow theory is the some of the theories proposed by Charles Dow in certain publications actually. So according to him, there were any market can move only in certain trend. Okay, so first one, he recognize it as uptrend actually. So in uptrend, how the price moves is it moves like this. Okay, so when we consider this as the low, and if we consider this as the high, so compared to this low, this made an higher low, right? Similarly, when we compare to this high, this is an higher high, right? Similarly, this is an higher high and this is an higher low. Okay, so in simple words, whenever the price is making higher highs and higher lows, we recognize, according to Dow theory, we recognize the price is in an uptrend. So if you are already holding the stock, there is no need to exit actually. Okay, so you hold this particular stock until the price keeps on displaying higher low, higher high, higher low, higher high. Okay, so whenever the price is displaying higher low, higher high, so this is recognized as the price is in a uptrend. Okay, I hope this is very clear. So the next one is actually opposite, downtrend. Okay, so it looks like this. Okay, so if you consider this has the high, swing high, this has the swing low, so compared to this swing high, this made a lower high, right? And compared to this low, this made another lower low. So this is another lower high compared to the previous swing high. This is another lower high. So this is another lower low. It goes on like this. So whenever the price makes lower high, lower lows, lower high, lower lows, we recognize the price is in a downtrend. Okay, so if you're invested some stocks, if some of the stocks in your portfolio displays this characteristic, it means they are in downtrend. So it is not advisable to hold the stocks which displayed or which are in downtrend actually. So no need to hold the stocks which are displaying these kind of characteristics. So until the price keeps on making lower highs, lower lows, lower high, lower lows, it is in a downtrend. Okay, so the last one is very simple. Whenever the price makes same high, same lows, same high, same lows, we recognize this is in a sideways trend. So this is the third one. So we recognize as this is the sideways trend. Okay, so in this case you don't make profit also. Okay, if you are very bullish, or if your plan is to hold this particular stock for long term, means you can hold this stock. But if your plan is to hold for only few weeks or few months, then there is no need to hold the stocks which displaying sideways trend actually. Okay, so there are only three trends: uptrend, downtrend, and sideways. In uptrend, higher high, higher low, higher high, higher low. In downtrend, lower high, lower low, lower high, lower low. So in sideways trend, sideways. So the fourth one is, it is very random actually. So we can see this kind of structure whenever the market is waiting for something, or whenever the market and very volatile. Sometimes it also displays V-shaped recovery and all. So this fourth is very random. This is very, this occurs very rarely. You can consider only uptrend, downtrend, and sideways trend. So we will see some of the chart, and we will conclude this. See, for example, so I'm in Nifty. If I go to weekly chart, see, if I go to weekly chart, see, from here to here, the Nifty is in uptrend, right? It made higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So it is an uptrend, right? So it is in a proper trending stock. So if you look at some other stocks also, for example, if you look at Titan stock, see, from here to here it is in an uptrend, except this particular thing, it is in an uptrend, right? So now we'll go to daily chart. For example, see, we can see the downtrend. For example, I will go to Nifty to show the downtrend thing. See, for example, here Nifty is in a downtrend actually. See, from here to here, it made lower high, lower lows, lower high, lower lows, lower high, lower lows, lower high, lower lows, right? Okay, so this is, if you consider this as a high, so this is low, this is a lower high, right? Again, this is lower low. So similarly, the Nifty is in a downtrend here to here. So in some example, you will also find some of the stocks which displayed sideways trend actually. Now, the most important thing is, Indra, you will ask this question, Indra, it is very easy to identify the trends The stocks which are in uptrend are in downtrend. But how do we identify the reversal? When to invest in a particular stock? See, that is very, very important, friends. See, assume a particular stock is in a downtrend, okay, or in a sideways trend. So whenever the first thing is it stops making a lower high. For example, this is a lower high compared to this, right? Again, compared to this is still a lower high, right? Still a lower high. But compared to this is an higher low, right? So this is the first warning. So first warning is it makes an higher low. So this is the first indication. So the second indication is, see, this is still an lower high, right? Compared to this is still an lower high. But compared to this, look at this. This is higher low, right? This is not lower high. This is higher. This is higher high. Okay. So the second warning is it makes an higher high. Okay. So whenever the price breaks this higher high level, the price breaks this higher level, this particular point, we consider it as number 3. So number 3 is the break. Okay. So the break of higher high indicates the end of uptrend. So number 1 is higher low formation. Number 2 is higher high formation. Number 3 is the break of that higher high point. See, for example, I will retain these things. I will go to Nifty chart. You see here Nifty is in a downtrend, right? Here the Nifty is in a downtrend. So first this is one swing low. First it made an higher low, right? It made an higher low. So if you consider this as a swing high, this made an another higher, right? So this is number 1. It made an higher low. This is number 2. It made an higher high. The break of this higher high indicates the end of uptrend. See, from here the price started uptrend. Okay. So this is very simple. So the next case is, assume you have taken the entry, but now when to exit the stock. So that is also very important, right? So exiting criteria we can recognize using end of uptrend scenario. See, for example, the price will be in an uptrend. Okay. It will be in an uptrend. So the first warning is it stops making, see, compared to this higher high, this is still an higher high, right? Now compared to this is an lower high, right? So the first warning symbol is it makes an lower high. This is very, very important. And number second is, this is number 1. So number second is, see, this is higher low. This is also higher low. But compared to this is a lower low, right? Okay. So the second formation is it makes a lower low. So this is the second important caution. So once the price break this level, the breaking point can be considered as number 3. Okay, this break is very, very important. See, number 1, formation of lower high. Number 2, formation of lower low. Number 3, the break of lower low. So this indicates end of uptrend. See, friends, from here the price can go sideways and then might go up, or it can go downtrend. But our logic and aim should be to exit. We should book the profit, right? We should not carry the stocks which displays downtrend actually. So at this point of time, if you are holding this particular stock, it is better to exit. In the future, if it displays uptrend once again you can take an entry. There is no problem, because whenever we see danger, it is better to step aside, right? So when we can't see any danger, we can always step in and we can run forward. Okay, so that is the idea of this. So this is how one can deploy, or one can use Dow theory to pick the stocks. So you can also see the thing here. For example, See, it was in an uptrend here. It made an, see here, it made an lower high. So compared to this, it made an lower low here. When the price broke this, it's end of uptrend. It went till here. Okay, so this is how we can use this. So Dow theory is one of the important technical concept in technical analysis for long-term investment. So apart from this, we do have many concepts like, you know, support or resistance. We do have some indicators. We do have some price action analysis based on price, volume. We do have some analysis as open interest. So technical analysis is also like a big C. We have many trading concept. So this is enough for long-term investment as per the technical analysis. So if you want to know more further concept, means you can read my book How to Make Money in Stock Market Trading, or you can also read my blog. So if you come to if you type indrajit.com, I have a blog. So you can come to indrajit.com website. If you click on blog, you know it, I have written many articles on many trading concept. You can check this, or you can also read my books, or if you come to courses, there is a free course like Beginner's Guide to Stock Market Trading. So you can take this course. This course is completely free, and I explained some of the important and interesting trading concept in this course actually. Friends, I hope this video is really helpful. So if yes, please like the content and you can share this video with your friends. Thank you. See you in the next video. Bye bye.